All right, how's everyone doing? Lewis here, back with some market updates. We're going to be talking about the Sacramento real estate market and what exactly has been going on. It's been a couple months, maybe two and a half months since I've actually made a video. I apologize for that. Frankly, it has just been challenging to stay very consistent when I'm juggling work obligations as well as family obligations and things like that. So I'm trying to get back into the swing, keep you guys updated on what is happening here in the housing market. But for today's video, I want to talk about what is happening locally in my market. So I have a bunch of stats and facts. We're going to talk about what's going on. We're going to talk about mortgage rates, what's happening with affordability, and we're going to even touch on the California Dream for All program and how that may impact transactions moving into May. So let's go ahead and jump right into it. If you are new to the channel, I make these videos to keep everybody updated as to what's going on in the housing market. A lot of times we talk about national stats and facts, but I'm also going to try to incorporate what's happening in my local market because I'm in that market each and every single day. So hope you enjoyed the video. If you're new here, please consider subscribing, hit that like button, and let's get right into it. Okay. So up on the screen here, I have some data, the for sale, sold, and pended, meaning under contract homes. These are from Sacramento, Placer, and El Dorado County. So 3 counties, and gives us a breakdown on what exactly is taking place. So the light green bar here, this is your inventory. It's homes that are actually listed for sale. And what I want to point out here is that at the moment, we are seeing a nice little uptick in the number of units for sale. We're sitting at just over 2,000 units listed for sale. And you can see that we've seen a steady increase month over month going into the spring and summer months. And this is pretty typical. If you go back a year, we look at January last year, we had higher levels of inventory. They came down slightly, but then they went up, peaking in, looks like October here. I suspect we're going to continue to see inventory levels rise going into about June, July, maybe extending a little further depending on what happens with mortgage rates. We'll talk about that here in a minute, but mortgage rates have gone up a little bit. So we're going to see days on market increase, and likely this inventory is going to build a little bit. Now, the red line here, this red line indicates what has actually gone under contract. And you can see that sales levels or homes put under contract remain relatively low until the new year. We saw a spike in January. They flattened out a little bit, and then a rather large spike from February going into March. Now, this time frame right here is when mortgage rates had actually dropped down. And now back at the end of March and early to mid-April, where we are today, rates have gone back up. So I suspect we're going to see another flattening of this line going into April and into May. But time will tell. We'll keep an eye on it. Actual transaction volume, it has gone up as well. This is a seasonal norm for us, but you can see that compared to prior years, it's slightly lower. And so with the lack of affordability here in the housing market, unfortunately, I do think that sales are going to remain rather compressed here for the next maybe 6 to 12 months, depending on what happens with rates. One thing that I do know for sure is that the market is hypersensitive to the mortgage rates and affordability. All right, now let's go ahead and take a look at the average price per square foot. I think one of the misconceptions, or maybe not misconceptions, but rather one of the things many people thought, including myself even, is that affordability would have to improve in some way. Now, affordability is really a metric or a function of 3 different things. It's price, it's mortgage rates or your payment, and then it is your wages. So we have seen wages rise, but they haven't really kept pace with inflation. We have seen prices come down a little bit, but they quickly rebounded due to the lack of supply. So that supply constraint that we're seeing here in the market has ultimately kept home prices elevated. And then mortgage rates have gone up. So it's kind of a dual, we're kind of getting hit from both sides here. We have higher rates, which crushes affordability, and then we have higher and steady prices. We haven't really seen that big pullback in prices that I think a lot of people thought was coming based on that large move in mortgage rates. Anyway, this right here is average price per square foot. This is one of my favorite ways to gauge value in the marketplace. So as of the end of March, we're sitting at about $340 as a price per square foot. Now, this is up year over year about 5.3%. So we're actually seeing home prices rise. Now, typically, we do see home prices go up into the spring and summer months, and then they come down and moderate slightly going into the winter months. This is pretty typical. You can see back here in January, it started a little lower. We saw price per square foot go up, then it flattened out, came down slightly, and then now, we're back up a little bit. Okay, let's talk about days on market. So average days on market here, we are now sitting at 35 days. You can see that the days on market has actually trended back down slightly from where we were in December, January, and February. This means that homes that are listed, priced correctly, they are moving quicker than they were a couple months ago. And that's just a testament to where we are in the marketplace. There is still a pretty good amount of buyer demand out there and a low level of supply. And so those homes that are priced well, they show really well, and they're in a really good location, I'm seeing those move rather quickly in today's housing market. Now, if you take a look at this red line, this is the original sales price, the sales price, like what the home actually closed for versus the original list price of the property. And it gives us a percentage. Right now, we're at 99%. So what this means is that homes on average are selling for 99% of what they're typically listed for. So they're selling for slightly less than what they're listed for on average. We've seen many properties in this area sell for significantly more though. That's one thing that is important to mention. All right, now this chart here, this is the average price for sale versus sold. We have average sold price in the 3 counties coming in at $663,000 versus the average list price, which is coming in at $882,000. All right, and then the last one that I want to talk about is months worth of inventory. We generally see inventory levels creep up slightly going into the spring and summer months. At the moment, we're sitting at 1.6 months. This chart only goes back a little over 12 months, but you can see here, this is historically low. And just kind of like a point of reference for context is that anything less than 3 months worth of inventory, meaning if no other homes hit the market, it would take 1.6 months in this case to sell everything that's currently available. Well, anything less than 3 months is what we would consider a seller's market. And then 3 to 6 months is more of our neutral market, and anything over 6 months is what we would consider a buyer's market. So we are still very much in a seller's market at this point in time. And it is competitive out there. It's very challenging for home buyers to get on the property ladder right now for a variety of reasons. One is lack of inventory. 2 is mortgage rates and affordability. So let's talk about that. Let me go ahead and pull up a chart here. All right, so right here, this is from Mortgage News Daily. This is going to give us the average rates here in today's market. And oh, by the way, just a quick something that I wanted to mention. The editing on these videos takes a tremendous amount of time. And so one of the things that I told myself is that if I'm going to get back into doing these videos, I wanted to reduce the amount of time I spent editing. So I'm going to try to do this unedited for the most part with maybe a little bit of cleanup. But I wanted to mention that if the videos seem a little longer, if they're not quite as smooth, I apologize. I'm just trying to be more of my natural self, and I'm trying to, produce more content that is helpful, but without having to do all of the back end edits, because I don't have an editor. I was just doing everything myself, and it takes a tremendous amount of time. So hopefully this will cut down on some of that time, which will allow me to focus on what I actually like to do, which is produce more content for you guys. So anyway, here's the mortgage rates. This is Mortgage News Daily. You can see we have the average 30-year fix coming in about 7.44%. We can see the Govy products, so 30-year FHA and VA, they're hovering in the upper 6% range. Here's a chart of where mortgage rates were over the last 12 months. You can see that mortgage rates started last year at about 6.4%. They started trending back up, peaking out here in October of 2023 at about 8%. And then they began to fall back down, landing right about in the mid 6% range. And mortgage forecasters was saying, these rates are going to continue to fall. That, unfortunately, is really not what happened. We've seen the mortgage rates sort of chug along. More recently, when the CPI data came out, stickier than usual inflation, we started to see markets price in higher mortgage rates, and now we're sitting at about the 7.5% range. This, I think, really starts to shrink our buyer pool and impact affordability. Obviously, right? Because the cost of debt is so much higher. And with about 70% of transactions requiring mortgage financing, we're starting to shrink the buyer pool. Now the bad news about this is that less people can afford to get in the market and get on that property ladder, start investing in their homes, and you have a huge millennial demographic that is moving up. They are in prime buying age. They want to buy. I fall into this category myself. We've been looking for a very long time. It is hard out there. It's very challenging to get involved here in the market due to that lack of inventory, and just the cost of capital is so high. But on a more positive note, with the higher rates brings less buyer demand, and there are more opportunities to get involved in the market. Because one thing that I do know for certain is that when mortgage rates were sub 7%, even approaching that mid 6% range, which was just recently, all of a sudden, some of the properties, at least locally, were getting multiple offers, and some going well above the asking price, making it very challenging. At least that's what I'm seeing anecdotally here in my market. All right, and the last thing that I really wanted to mention was this California Dream for All program. The reason I want to mention this is because the registration portal is only open until the end of April. Now, for those of you who are not familiar with this, I'm not going to go into great deal, but this California Dream for All, it's a shared appreciation loan where Cal HFA essentially offers up to 20% for the down payment and closing costs, not to exceed $150,000. So in other words, they will give you $150,000 to apply towards your down payment and closing costs. And in return for that, they will share the appreciation of the upside in that property as you hold it over time and the value goes up. Now, the reason I'm mentioning this is because this really impacts home buyer demand. It's a lever. It's a demand lever. It's not bringing more supply to the market. Registration closes at the end of this month, which means that there's a lottery, which means that the lottery that they have set up to pick who the participants will be, that's going to open up sometime in early May. Once they start picking who is going to be able to take advantage of this program, they have 90 days to identify and close on a property, which means that home buyer demand, at least in California, is likely to increase sometime in early May, which could potentially, if you're a seller in this market, make it a great time to get your home listed. It's also, even with the higher rates, I imagine it's going to bring more competition, which means, unfortunately, it may get a little bit more challenging for buyers in the short term. Anyway, that's going to wrap it up for today's video. I hope you found some value in it. If you did, consider liking, subscribing, and we will see you on the next video. Take care. Thanks so much.